now we will start discussing the recording process and also the posting step to the general ledger. And we have this first transaction on October 1st. Bird invests $10,000 cash in an advertising company called Pioneer Advertising. In order to do the journalizing and also to post to the general ledger, first we have to do the basic analysis. We need to know how this transaction affected the accounting equation. On October 1st, Bird made an investment by $10,000 cash, so cash increases. It will be written in the left-hand side by a positive value, as you see, $10,000. Then, at the same time, our owner's capital, owner's equity increases by $10,000. And this is equation analysis. We performed first an analysis to this transaction. Then, we should determine which item will be debited and which item will be credited. Since asset increases, we have stated, according to debit and credit rules, that any increase in assets will be written in the debit side. So cash, on October 1st, the journal entry, you should write first the date, journal entry October 1st, cash is debited by $10,000. And also any increase in capital should be credited. So owner's capital would be written in the second line, and you should move slightly to the right and write owner's capital by $10,000. And this is the journal entry. So first, we made a basic analysis for the transaction. You should know how this transaction affected the accounting equation. And this transaction mainly caused an increase in assets by $10,000 through cash, and also it increases owner's capital by $10,000, which will also affect or cause an increase in owner's equity. Then you should determine the debit and the credit analysis, which item will be debited and which item will be credited. Then you should perform, or you should write the journal entry starting by the date, October 1st. Cash is in the debit side by $10,000. Owner's capital will be in the credit side by also $10,000. So the total debit amount is equal to the total credit amount. And the third step is posting. You should post this transaction to the general ledger. And we have stated that we will use a simple format of general ledger, which is a T account. And we will prepare a T account for each item. Cash, T account, as you see, we have a debit side and a credit side, and we will transfer this cash by the $10,000 to the T account in the debit side. October 1st, $10,000. Then you should also perform a T account for owner's capital. And owner's capital T account, you will write the $10,000 in the credit side. You will transfer this $10,000 from the journal entry in the credit side to the T account in the credit side. The second transaction on October 1st, Pioneer purchases office equipment costing $5,000 by signing a 3-month note, 12%, $5,000 notes payable. Again, you should do the basic analysis, how this transaction affected the accounting equation. We purchase equipment, we purchase an asset, so our assets item will increase by $5,000. But we didn't pay cash for this transaction, we purchased this item on account. By signing a 3-month note, 12%. So our notes, our liability will increase by notes payable. So now we have a note payable, an obligation by $5,000. Then you should journalize this entry. Any increase in assets should be debited, so equipment will be written in the first line by its debit amount, $5,000. And notes payable also, our liabilities increases, and when there is an increase in liability, it should be written in the credit side by $5,000. After journal entry, you should post this transaction, this journal, to the T account, to the general ledger. You will perform now a T account for equipment and also another T account, another separate T account for notes payable. And we will transfer these items. Equipment is written in the debit side, so it will be posted, it will be transferred to the general ledger in the debit side by $5,000. And also, Notes payable is written in the credit side in the journal entry, so it will be transferred in the credit side of the T account by the same amount, $5,000. The third transaction, on October 2nd, Pioneer receives a $1,000 200 cash advance from Knox, a client for advertising services that are expected to be completed by December 31st. So we performed we received a cash in advance, and we are expected to perform this service in future, and it will be completed mainly on December 31st. So the asset as a cash increases by $1,200. And now, can we record a service revenue? No, because we didn't perform this service. So now we have a liability, which we call it unearned service revenue. We have an obligation to perform this service on December 31st. So our unearned service revenue, our liability will increase by the same value, which is $1,200, because the service hasn't been performed yet. And when Pioneer receives an advance payment, it should record an unearned revenue as a liability in order to recognize the obligations that exists. And you also should notice that most liability have the word payable in their title, while unearned revenue is considered a liability because the liability is satisfied by providing a product or performing a service. Let's journalize or record this entry. First, if we perform the analysis or equation analysis, our cash as an asset increases by $1,200, and also liabilities will increase as an unearned service revenue by the same value. So the left-hand side of the accounting equation increased, and also the right-hand side of the accounting equation increased by the same value. The journal entry, when cash increases, it will be written in the debit side. So we have cash by $1,200 in the debit side. Then in the second line, you should write the credit amount, which is unearned service revenue, by the same value, $1,200. Post this transaction to the general ledger, post this transaction to T account. We will we performed a cash account. So now on October 2nd, our cash increases. It will be written in the debit side by $1,200. We transferred the amount from the journal entry to the T account by $1,200. Then the T account for unearned service revenue, we will transfer the same value, which is journalized by $1,200, will be transferred to the T account in the credit side by $1,200. Transaction 4, on October 3, Pioneer pays office rent for October in cash, $900. So the expenses account, mainly rent expense, increases by $900 because the payment pertains only to the current month. And also the cash as an asset item decreases by $900 because we paid for an expense cash. So our cash decreases by $900, and rent expenses will cause a decrease in owner's equity by $900. And as we have stated in the debit and the credit rules, when expenses increases, you should write this in the debit side. So rent expense in the journal entry will be in the debit side by $200, and cash, when cash decreases, it will be credited by the same value, $900. Then you are also required to post this transaction to the T account. In this transaction, cash amount $900 will be transferred to the credit side of the credit side of the T account by $900. And rent expense, we perform now a new T account for rent expense, and you will transfer this value, $900, from the journal entry in the debit side to the T account in the debit side by $900. On October 4, Pioneer pays $600. On October 4, Pioneer pays $600 for a one-year insurance policy that will expire next year on September 30. So we paid in advance $600 insurance which will expire next year. In order to analyze this transaction and its effect on the basic on the accounting equation, the asset will be, since you paid something in advance, now we have something called the prepaid insurance or prepaid expenses. And prepaid insurance is considered an asset. So asset prepaid insurance increases by $600 because the payment extends to more than the current month. And the asset cash will decrease by $600 because we paid for this transaction in cash. Payment of expenses that will benefit more than one accounting period are prepaid expenses or prepayments, and these prepayments are considered as an asset. When a company makes a payment, it debits an asset account in order to show the service or the benefits that will be received in the future. So here, in the accounting equation, cash will decrease by $600, and at the same time, another asset item, which is prepaid insurance, prepaid expenses, will increase by $600. We will journalize this entry, so the first you should write the date on October 4. Prepaid insurance is an asset, should be written in the debit side. Cash is decreases, and cash also is an asset, but when cash decreases, it will be written in the credit side. Then you should perform a T account. We started before a cash account, so now we will transfer this value, which is the 600 in the credit side, here to the credit side by the same value. And we will perform a T account for prepaid insurance, and this is the debit side, and here is the credit side. And since prepaid insurance is journalized in the debit side, we will transfer this value in the debit side of the T account by 600. On October 4, Pioneer purchases an estimated 3-month supply of advertising materials on account from Euro Supply for $2,500. So we purchased supplies on account for $2,500. So our asset supplies mainly increases by $2,500, and we made this transaction on account. We didn't pay cash. So now we have a liability, and accounts payable increases by the same value. So the effect of this transaction on the accounting equation, supplies will increase here by $2,500, and also the right-hand side of the accounting equation, accounts payable will increase by $2,500. Debit and credit analysis. Debit increases as an asset, so we will debit supplies. In the journal entry, supplies is written in the debit side. And also we have an accounts payable, our liability increases, and when liability increases, it should be credited, so accounts payable will be credited by this value, $2,500. Then you should transfer this journal entry to the posting or to the T account. We will perform a new or an individual T account for supplies, and we will transfer this amount from the debit side of the journal entry to the debit side of the T account by $2,500. And also we perform a T account for accounts payable, $2,500. This will be transferred in the credit side of the T account by the same value, which is $2,500. On October 9, Pioneer hires 4 employees to begin work on October 15. Each employee is to receive a weekly salary of $500 for a 5-day work week, payable every 2 weeks. And the first payment is made on October 26. So, a business transaction hasn't occurred. We don't have any transaction or a business transaction. Only what the company did is it hires 4 employees, and they will begin their work on October 15. But now we are on October 9, and we are required to journalize this entry on October 9. So what do you think? Can we record a transaction now? We have stated before that in order to consider this as a transaction, there should be an exchange between 2 parties, and this exchange should involve a dollar value. But the activity of hiring 4 employees to begin work on October 15 is not considered as a business transaction. It's only an agreement between the employer and the employees, to enter into a business transaction beginning on October 15. So on October 9, no entry will be recorded, while on October 15, we will start, the first payment will be made on October 26, so we will see this in October 26 for the first entry. And on October 15, a debit and credit analysis is not needed because there is no accounting entry. So our accounting transaction will start on October 26. On October 20, Bird withdrew $500 cash for personal use. So the owner's equity account mainly will decrease through owner's drawing. Our owner's drawing increases, and when owner's drawing increases, it causes a decrease in owner's equity by this value, as you see here, $500, by a negative sign, because owner's drawing causes a decrease in owner's equity. And since we withdraw 500 cash from the business, so assets as a cash decreases by the same value, $500. What about journalizing? On October 20, owner's drawings. Our drawings increases by $500, and when drawing increases, it causes a decrease in owner's equity. And also cash decreases. When cash decreases, it will be credited by $500. Then we should transfer this journal entry to the general ledger through the T account. We will transfer the credit amount of cash here to the credit side of the T account by $500. And we will transfer the debit journal entry, owner's drawing, to the debit side of the T account by $500. On October 26, Pioneer owes employees salaries of $4,000 and pays them in cash. So on October 26, we paid our employees the salary by $4,000 in cash. So our cash will decrease. Cash as an asset decreases by $4,000. And owner's equity, we have here expenses, and as we stated before, expenses cause a decrease in owner's equity section by $4,000. Debit increases expenses. Debit salary and wages expense. So now, salaries and wages expenses increases, and when there is increase in expenses, it should be written in the debit side by $4,000. Then our cash decreased, and in decrease in asset, it will be credited by the same value, $4,000. Transfer this journal entry to the T account. Here our cash is written in the credit side. It will be transferred in the credit side of the T account by the same value. Salaries and wages payable is written in the debit side, so it will be transferred to the T account of salaries and wages payable by the same value of $4,000. On October 31st, Pioneer receives $10,000 in cash from Coupa Company for advertising services performed in October. We have performed a service already in October, and now we received this amount. So now we received cash. Our cash increases by $10,000 as an asset, and also we have to record or to recognize a service revenue because we performed a service. So service revenue increases, and in increase in service revenue causes an increase in the accounting equation, mainly in owner's equity section. Cash increases, it will be debited by $10,000. Service revenue increases, so it will also credited by the value $10,000. Let's transfer this journal entry to the T account. So we will transfer cash, it is $10,000, from the debit side here to the debit side of the T account, $10,000. Service revenue, $10,000 in the credit side will be transferred to the T account of service revenue by the same value, $10,000. And this is the summary of journalizing and posting which we have made in this prior illustration. This table summarizes all the journal entry performed. And this is the summary of general ledger which we already performed. And this is a standard format, but in our accounting principles course, we will perform posting through a T account. And here we come to the end of our lecture. And next week we're gonna continue discussing chapter 2. Today we discussed objective number 2, journalize transaction, how to record or to journalize business transactions, and how we post these transactions to general ledger. While in the next week we will continue discussing the remaining objectives, which is mainly one objective, objective 5, preparing a trial balance. And then we will try to do some exercises to cover this chapter. Stay safe and thank you.